What if the very safety you are clinging to is actually costing you a small fortune? I remember the exact moment this reality hit me like a ton of bricks. I thought I was doing everything right by sticking with the reliable S&P 500 index fund. It is the standard advice given by every expert, every book, and even Warren Buffett himself. But as I started digging into the data, I realized I had been leaving a staggering amount of money on the table without even knowing it. If you are like most investors in their 50s or 60s, you value security above all else. You want to protect what you have built, and that makes sense. But there is a hidden risk in playing it too safe. It is the risk of assuming your portfolio is already optimized when it is actually just coasting. Today, we are going to look at one specific exchange-traded fund that has been quietly outperforming the broader market year after year. It is not a risky tech startup or a speculative crypto asset. It is a smarter way to own the exact same companies you already know. By the end of this video, you will understand how a simple shift in strategy could have turned a $10,000 investment into a massive gap of over $136,000 in just 2 decades. The real risk is not in trying something new. The real risk is in assuming that the default route is the best one for your future. Let's start with the comfort of the familiar. Buying a broad index fund like VOO feels almost foolproof. It is simple, it is low cost, and it is backed by decades of historical success. You're not trying to outguess the market. You're just letting it work for you. But beneath that sense of security, something subtle happens over time. Each year that passes, a small slice of potential return quietly slips away. Most investors never notice until the compounding math makes it impossible to ignore. Think about how you buy an index fund. You open your brokerage app, you type in the symbol, and you buy the entire S&P 500. You have heard it beats most active funds, and that is true. But once simplicity becomes the same thing as safety, your curiosity often stops. You stop asking whether there might be a more disciplined, long-term approach that captures a little more of the market growth. That is where the opportunity cost starts adding up quietly and consistently. Let's put this into perspective with some hard numbers. Suppose 2 investors each start with $10,000. One buys VOO, the well-known S&P 500 fund. The other invests in a fund designed to capture momentum within those same 500 companies. Over the past decade, that difference translated into about a 14% average annual return for the standard index. But the more targeted approach yielded around 18%. On paper, that 4% gap might not sound like a game changer. But thanks to the magic of compounding, it is absolutely massive. After 10 years, the standard investor would have roughly $37,000, but the other investor would reach about $52,000. That is over $15,000 in missed growth in just the first decade. Now, let's stretch that difference across 20 years. At a consistent 14% return, your $10,000 grows to about $137,000. But at 18%, that same investment climbs to nearly $274,000. That is a gap of more than $136,000, all from a seemingly modest 4% edge in annual performance. This is not about market timing or speculation. It is simple math playing out over time. The longer you hold your investments, the wider this gap grows because every percentage point compounds on top of the last one. The psychology behind staying in a standard index fund is understandable. It offers peace of mind. You do not have to worry about choosing the right individual stock, and that makes it easier to stay invested when things get volatile. That emotional stability is valuable. But comfort can come at a very measurable cost. It reinforces the idea that lower perceived risk always equals better long-term results. In reality, efficiency matters just as much as safety. A more selective approach can still be diversified, passive, and disciplined. It is just more refined. To be clear, there is nothing wrong with traditional index investing. It has helped millions of people build wealth and stay consistent through every market cycle. But passive does not necessarily mean optimal. Treating the S&P 500 as a one-size-fits-all solution ignores the fact that better tools now exist. There are exchange-traded funds that enhance the same principle of capturing the best of the market while maintaining broad exposure. These funds use transparent rules and periodic rebalancing to tilt towards performance rather than just size. While most investors still default to just buying the whole index, a smaller group is quietly taking advantage of this evolution. They are not chasing short-term fads or betting on speculative sectors. They are using smart funds that automatically reward strength and trim weakness. It is the same philosophy of consistent long-term investing, but tuned more intelligently. And once you see how clearly those extra returns compound over time, it changes how you think about what safe really means. There is one fund in particular that has been doing exactly this. It is called SPMO, the Invesco S and P500 Momentum Fund. It is not new, it is not flashy, and it is not themed around the latest market craze. Instead, it quietly applies a smarter structure to the same group of companies you likely already own. SPMO does not try to predict the next big winner. It simply filters the S&P 500 through a different lens. It favors stocks with sustained strength over those that are just coasting along. And that small design change has made a huge difference over time. While a traditional fund like VOO owns all 500 companies, leaders and laggards alike, SPMO focuses on roughly 100 of them. These are the companies actually driving most of the market gains. It does not guess which industries will surge next. Instead, it uses hard data. Every 6 months, its system identifies which stocks have demonstrated the strongest momentum. These are the stocks consistently performing better than their peers. The fund then rebalances accordingly. It is a disciplined process that blends the steadiness of indexing with the precision of performance-based selection. If the S&P 500 were a professional basketball league, SPMO would be the all-star roster. It does not replace the league. It just highlights the players currently putting up the best numbers. As with any all-star team, the lineup changes regularly. Every 6 months, the fund benches the underperformers and adds those rising in form. This ensures the portfolio does not carry dead weight. Traditional index funds cannot do this. They are forced to hold on to every stock, regardless of whether it is driving growth or dragging behind. That is where the design of SPMO quietly compounds its advantage. Now, you might be wondering about the cost. VOO charges about 0.03% annually. SPMO comes in at 0.13%. It is a small gap that often turns some investors away. But what that extra 0.1% buys you is a systematic structure. It is a method that continuously reallocates your money towards proven strength. There is no fund manager making emotional judgment calls based on headlines. It is just a steady, math-based process aimed at maximizing efficiency. If that slightly higher cost yields significantly better compounded returns, the difference becomes trivial. Many investors resist these strategies because they think it sounds like chasing winners. But SPMO is not about jumping into hype stocks. It uses objective data and a consistent schedule. Its methodology is published and transparent. It reacts to real results rather than narratives. This fund sits in the middle ground between passive and active strategies. You still get diversification, simplicity, and low cost, but you also gain an intelligent mechanism that shifts with the market in real time. It is methodical rather than emotional. It is an approach that strengthens during expansion phases and adapts quickly when conditions change. And that adaptability raises an important question. How does a momentum fund behave when the market turns volatile? It is one thing to thrive during a bull market, but resilience is truly tested when things get rough. What happens when the market turns against you? That is where the real test begins. For a momentum fund, the natural assumption is that it will stumble hardest when conditions shift. After all, if it is built on chasing strength, what happens when strength disappears? It is a fair question. But when we examine the data, the track record of SPMO during turbulent years reveals a pattern of resilience. Take the year 2018, for example. The S&P 500 ended that year down about 4.5%. SPMO, however, slipped only around 0.9%. It was not immune to the pullback, but its rebalancing process helped it sidestep a good portion of the decline. Then came 2020, a massive stress test for every investor. When the markets plunged in March, both funds fell swiftly. But as the recovery took shape, SPMO's adjustment had already realigned it towards the sectors leading the rebound. By following measured momentum rather than emotion, it climbed back to previous levels noticeably faster than the broader index. Even in 2022, when inflation sent markets into a tailspin, SPMO managed to lose less than the standard index. VOO was down roughly 18%, while SPMO was down closer to 10 or 12%. That gap matters because a portfolio that loses less needs a much smaller gain to break even. Smaller drawdowns shorten your recovery periods and preserve your compound growth. That is the foundation of long-term performance. So, how should you integrate this into your own portfolio? It is not about replacing what already works for you. It is about enhancing it with purpose. No single fund should carry your entire retirement plan. The real edge comes from blending momentum intelligently with your existing core holdings. The surprising part is how even a modest slice of SPMO can noticeably shift your long-term results. Since it captures momentum within the same S&P 500 universe, adding it does not overhaul your entire approach. It simply adds a layer of efficiency. A conservative investor might keep 90% in a broad index fund and pair it with 10% in SPMO. That small portion gives you a taste of higher returns, while keeping your volatility almost identical to what you are used to. A moderate investor might aim for a 70-30 split. This captures more of the rotation effects and can significantly boost long-term growth. None of these allocations is a fixed formula. They are starting points for you to tailor, based on your own goals and your ability to stay disciplined. Think of your broad index fund as a reliable engine. It keeps your portfolio steady during unpredictable stretches. SPMO is like premium fuel for that engine. It gives you a higher gear when momentum drives the markets forward. The real discipline is not in picking the right allocation once. It is in sticking with it through the full cycles. Momentum investing works best when you let the rebalancing engine operate as designed without interference. Trying to jump in and out based on your gut feeling undermines the system. SPMO already handles the heavy lifting behind the scenes. Your role is to give it time and consistency. The smartest use of this strategy is not aggressive trading. It is the careful refinement of your overall approach. Investing is not about following the crowd or finding the flashiest new fund. It is about quietly optimizing what you already do well. It is about making decisions that compound into something bigger over time. True growth comes from intention, not just comfort. Sometimes staying in your comfort zone is the biggest risk of all. Are you letting the market carry you, or are you steering your results with intent? The second million is closer than you think, but only if you have the right tools to get there. Take a look at your mix today and ask yourself if you are truly optimized for the future you want to build. Success in retirement is built on the choices you make when no one else is watching. Make sure your choices are working as hard as you did to earn that money in the first place.